risk disclaimer. A risk disclosure statement stating all possible risks associated with Forex market. By accepting the risk, you're also proceeding further with me. Online educational materials are developed by Admiral Markets and Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author, it's me, and in no way it represents the actual suggestion for the trade. These are not MUK's opinions, and the website in the video is not the .co.uk website, but the globalnews.com website. Forex is risky business, and this is a personal opinion only. This webinar is for informational and educational purposes only. So with having said that, as I already told you at the beginning of the webinar, this is introductory webinar. We will be dealing with basics of Guppy moving averages. Then I will show you introduction to GMMA system. GMMA is abbreviation for Guppy moving averages. And then we will see conclusion of these examples. And as I said in one of our next set of webinars, we will be seeing more complex Guppy moving averages. So this is another basically another way to look in the market, and primarily it was developed by Daryl Guppy. That is the name, Guppy moving average. The thing is that Guppy MA consists of multiple fast and multiple slow MAs. So when he started to trade, he was obviously interested not to trade only one or two single EMAs or SMAs or weighted moving average. He introduced usually 10 moving averages, which are basically fast and slow EMAs. So in Guppy moving average, we are talking mostly and most of the time about exponential moving average. Trend trading is pretty much simple with Guppy moving average, but for trend trading we need to have definitely a strong trend. Another advantage of Guppy MA is also we can trade breakouts, and it's a pretty much unique way of trading basically. And the biggest drawback of Guppy MA is it cannot be traded, and it's very insecure and unsafe to trade it during non-trending markets. So first of all, we need to see that market is trending, and then we usually take second swing. So we can trade intraday, because most of the time Guppy MA is traded on intraday time frames. We can trade long and short, we can trade every pair, but we also need to pay attention to whipsaws. So that is why when we trade Guppy MA, we usually take not the first swing, but we take the second swing. And the precursor for the second swing is that we already have. So we need to have the trend established. So the primary concern is the trend. So the trend. Guppy MA just does not work without the trend. And when we see the trend, then we need to wait for the swing and then the second swing. And in this system, which I will be showing you, that is exactly how we do it. Now, the primary meaning of Guppy MA was not to trade it. It was basically about to identify changing trend. So by using Guppy moving averages, we are identifying a potential trend change, and we actually want to trade that trend change. So we do not simply analyze the market, then we do not wait for the confirmations. We first need to see the trend, and trend is exactly established, as we will see, by using 5 fast and 5 slow exponential moving average. It's usually traded on intraday time frame, and changing trends are identified when the two groups of moving average intersect. So we will all see that into example, but at the moment it's enough for you to know that changing trend are identified when two groups of moving average intersect. So we have two groups, fast and slow moving average, and when those two groups intersect, we call it a change of the trend. And we hope that the trend will be established. Bullish trend is present when the short-term moving averages are above the long-term averages. It's standard way of market estimation and trend estimation. Usually, you probably know when you have two exponential moving average, let's say blue and red. Blue is 5, let's say, red is 30. And usually when blue is above red, we say the trend is long. When the blue is below red, we say the trend is to the short side. And the thing is, with the bullish moving average, we will have all of them aligned above the second group of moving average. So we have fast and slow. In order for bullish trend to be active and valid, we need to have all of, remember, all of those fast moving averages above slow moving averages. Okay? So we need to have fast moving averages above slow moving averages. And not only one or two, we need to have the whole group of them above or below moving average. So same is for bearish movement. If the trend is to the bearish side, all of them, all of moving averages should be below long-term averages. Okay, so all fast moving averages should be below slow moving averages. Okay. Now, how we do with the trading signals? Trading signals are usually identified as multiple crossovers. Okay, so remember now, first most important thing about Guppy moving average is to identify the trend. That was the primary concern of Daryl Guppy when he traded and when he introduced us to Guppy moving average. So to identify the trend. Now the second part is how to trade it. We have trading signals using Guppy moving averages. Trading signals are usually identified as so-called multiple crossovers. Okay, so we need, again, pay attention to what I'm saying. I said we need to have the whole group above or below, so the whole group of fast EMAs above or below slow EMAs to identify the trend. The same thing goes with trading signals. We need to have the full group below or above the slow to identify the entry. Okay, so we need to have the whole group of fast EMAs to be above or below to give us the trend and the entry. Okay, we will see that in the system, but now it's very important for you to remember that the whole group needs to be above or below, not 1, 2, 3, or 4. If we have 5 of those EMAs, so all of those 5 EMAs should be above or below. When moving averages are parallel within the group and close together, then we say the trend is in place. Okay? Usually it looks like this. One group is inclined, let's say, to the upside, and it's above second group, which is also inclined to the upside. Okay? And we always have fast and slow exponential moving average. We don't do fast and fast, slow and slow. We use fast and slow. Okay? The trend is identified on Guppy moving averages when the lines of the long-term traders are spread out. Then the lines of the short-term traders are spread out. Okay? There is a growing gap between the short and long-term traders. That signifies an agreement between short and long-term traders. Okay? That is the logic behind the Guppy moving average. Short-term traders always initiate the trend but they need the support of the long-term traders in order to keep it going. So this is how it looks, guys. Red ones, we have 5 red, 5 blue. Red are slow moving average, EMA, and blue are fast moving average, okay? And those two groups are making Guppy moving average, okay? This is Guppy moving average. So the thing is, the line, now we go step by step. When we identified and how we identify a trend. Let's go to the step 1. A trend is identified when the lines of the long-term traders are spread out. These are the lines, guys, of long-term traders, okay? And they are spread out. Look how nicely they're spread out. This is not the trend. This is maybe the start of the trend. But we don't know whether this will be a trend or not. Look, they're pretty much close together. But this is the trend. This is the clear trend, okay? Because the lines are spread out, okay? Then we go to see step number 2, okay? The lines of the short-term traders are spread out, okay? This is not the trend because it might be the start of the trend. This might be the start of the trend. But it's still not the trend because these lines are pretty much close together, okay? Now, this is the trend. We have long-term traders. Now, red lines and red EMAs are long-term traders, guys. Blue lines and blue EMAs are short-term traders. Now, both long and both short-term traders are spread out. Look, this is retracement. Now, this is the trend, retracement, trend. Now, this is the change of the trend, this intersection here. And this serves as a potential sign that the trend has changed. But look here. Look at here. This is when we expect that the trend will develop. And only then when trend has developed, we can enter the market by using Guppy moving average signal, trading signal. Okay? So we don't talk about crossovers. We use crossovers only in analysis at this moment to identify the potential trend change. And this is the most important part. Long-term moving averages and short-term moving averages are spread out, and this is the trend. That is the time when we take retracements and go short in the market. Okay? Now, there is a growing gap between the short and long-term traders, and this is the gap. The space in between long-term traders and short-term traders is the gap. You see, there is no gap here because we expect the trend to change. We do not know whether it will change. It can go up, but it went down, and you see the gap. This gap is growing, and this is also the sign of a strong trend. Okay? And that is the step number 4. This signifies an agreement between short and long-term traders. Okay? Both short and both long-term traders are in agreement. How we know that they are in agreement? Simple. Because red EMAs are above blue EMAs. So long-term traders are riding the trend which short-term traders initiated. That is the conclusion. Short-term traders always initiate the trend, but they need the support of the long-term traders in order to keep it going. Now this is that conclusion, and you can see it here. We have blue EMAs which are basically mixed into this red EMAs, but they're still below these red EMAs. So short-term traders are hinting that this chart will go definitely down, but we need a confirmation that the chart will go down. So at this particular moment here, we can see that both short and long-term traders are making an agreement. And when this gap starts to be formed, we can see now that short-term traders and long-term traders are in agreement and that the trend to the downside has started, okay? The trend has started. Now, usual combination of GMMA include EMAs. Okay, these are not these are EMAs. These are not simple EMAs. These are not weighted moving averages, smoothed, or I don't know, Uric moving average. This is exponential moving average. Okay, so usual combination. Now I'm talking about usual combination for Guppy. So usual combination of GMMA include EMAs. The short-term EMAs used are 3, 5, 8, 10, 12, and 18. So those are the short-term EMAs, 3, 5, 8, 10, 12, 18. Then we have long-term EMAs, 30, 35, 40, 45, 50, and 60, okay? So these are usual numbers we have, okay? Now pay attention to what I'm saying, usual numbers. Those numbers can be changed, but usually these are the numbers which we use for Guppy trading. So these are usual. Some traders also love to call it rainbow because this looks like some sort of rainbow. But rainbow is something different. Rainbow, yeah, it uses a form of Guppy, but the form is other, and also it's not the same as Guppy moving average. But also rainbow chart is slightly different. Rainbow is the indicator which is more or less has the calculation similar to MACD, but it's a bit different in the nature, and it uses multiple of moving average. So it resembles the rainbow. But remember that this might look like some sort of rainbow, but it's not the rainbow in its full sense. Okay? So don't be confused if you ever find the term rainbow and you think that it's Guppy moving average. It's not. Okay? The important thing about Guppy moving average is that it works in trending environment. Okay? And it can be used with that previously mentioned rainbow indicator. But the thing is, only in trending environment you can hope for money to be made with Guppy moving average. If you have a constant whipsaws and the trend is constantly changing, what you should do, you should leave Guppy moving average aside and trade something different. Because as I said, Guppy moving average only works in trend environment. Okay? In trend environment. It can be used with rainbow indicator. Now, originally, Daryl Guppy was looking only for compression of the averages, the lines coming together in each group as a signal for a likely trend change. So this is the compression of both fast and slow moving averages, and this could be the signal that the trend will change. Okay? So he was looking for only for compression. He didn't look for anything other than that. Now, and/or for steady parallel or expanding lines as a continuing trend. So this is expanding lines here and the parallel which reflects the continuing trend. He stated that the idea is not a moving average crossover system, but today traders have modified it. So his original idea was not to implement a moving average crossover system. The idea is only to spot the trend, okay, to spot the trend and to spot the trend change. So originally, Daryl Guppy was looking only for, first, compression to tell him that the trend will start to develop. Then he was looking for a trend by using gaps in between short and long-term traders here. Then he used it as a potential signal that the trend can change, and that is here in this place. Because at this point, the third point, we can see that fast moving averages are protruding to these slow moving averages, and what did he say? Short-term traders, which are depicted as blue EMAs, always initiate the trend, but they need the support of the long-term traders in order to keep it going. So each time we have a rejection, long-term sellers and traders should appear and help, long-term traders should appear and help short-term traders to continue in the same direction. So they both need to work together, okay? Now, and again, Darrell stated that the idea is not a moving average crossover system, but traders now use crossovers, but most of them use bounces and retracements. That is what I will show you today. Bounces on Guppy moving average. How to trade. This is, as I said, introduction, and this is pretty much straightforward system for Guppy moving average. And as I said, you can try to test it. You can see how it behaves, but also pay attention, because in one of our future webinars, I will be explaining about more complex Guppy moving average system. Okay? So, of course, as always, you know how I teach. We always go from simple to more complex. So we will start with simple one, yet effective. So first of all, insert 5 slower EMAs in red color. Okay? EMAs should be 30. I will speak slowly so you can actually memorize this chart, and you can use it to trade the system. So insert 5 slower EMAs in red. Those are 30, 35, 40, 50, and 60. Red EMAs are long-term traders, so they are depicting long-term traders. Then you need to put on the chart short-term traders. Short-term traders are 5 faster EMAs in blue color. Those are 3, 5, 7, 10, and 15. Okay? So now we have 5 slower EMAs and 5 faster EMAs. When you insert those two together, you will get this. Okay? So these are exactly this. 30, 35, 40, 50, 60, 3, 5, 7, 10, 15. Okay? Now, first steps is the system is traded when faster EMAs cross slower EMAs. So they can be, it can be to the bullish side, and also it can be to the bearish side. The important thing is to know all blue EMAs must cross. We use Fibonacci tool, and we will use confluence of Fibonacci, and we trade bounces or bounce of EMAs. Okay? That is what we do with this system. Okay? So we use Fibonacci tool, we trade bounce of EMAs, and all blue EMAs must cross. Okay? All blue EMAs must cross. We should not leave any behind. Okay? So indicators which we will be using for the system are Guppy EMAs and Fibonacci tool only. Okay? So only Fibonacci tool and Guppy EMAs. Rules are pretty much simple. Wait for the fast moving EMAs to cross slow moving EMAs. Okay? That is what you need to wait. Wait for the price to retrace and hit multiple Fibonacci levels. Enter a bounce trade. Okay? Those are the rules, guys. Okay? And finally, we trade it on 15-minute time frame. Now, the thing is, there will be another rule which I will be showing you after this, but this is the first rule, and this is how originally the system should be traded. Okay? Again, memorize this slide. Wait for fast-moving EMA to cross slow-moving EMA to give you the trend direction. Okay? Then you need to wait for pullback to EMAs. Okay? You always need to wait for a pullback. In this case, EMAs. Wait for the price to retrace and hit multiple Fibonacci levels, and then enter a bounce trade. Okay? 15-minute time frame. So this is step 1. Wait for fast-moving EMAs to cross slow. This is the time when fast EMAs crossed slow EMAs. This was also the cross here, but we didn't have any bounce, so we need, that is, now look at the logic. That is why you need to wait for the bounce. Look at this. You cannot trade the crossovers. This was crossover here, but we didn't have any bounce. Look, these blue EMAs, or how we call it, short-term traders, they were advancing to the upside, and then only then at this point they brought it down. And now this was the retracement basically here, but it was simple one, and basically this was the second time when price has pulled back to EMAs. So that is why you need to wait for the bounce. So first step is wait for fast moving EMAs and wait for a pullback. Okay, so EMA's pullback has happened here. Okay, so step 2 is wait for the pullback and draw Fibonacci from last swing and previous swing and find a confluence point. So this is the first step, and we can see that the price has established bearish trend. Second step is this is high, this is low. You put your Fibonacci from this point to this point, because after this you have a retracement. Look at this, we have retracement, and then previous high and low. So previous high, previous low. The confluence is this. Look at this confluence. The first confluence is here, the second confluence is here, and the third confluence we wouldn't trade because it's above. So the price needs to be, in order to execute the trade, the price needs to be in between blue and the red. It's always best when it hits red first, and it should be also touching Fibonacci number. So we don't wait for the candle to close. We are trading living candle, and we are trading actually the touch of the level. Once the price hits the level, we enter the trade. Okay, this is the confluence point here, and look at how price behaved. When you are not able to draw Fibonacci, 2 Fibonacci retracement, because sometimes we will see some examples, there are not always opportunities to draw 2 Fibonacci levels. We only use one. So we draw a Fibo, we wait for 50, 61.8, 78.6 touch, along with slower EMA touch, so red, and enter a trade. Okay, this is the occasion. This was basically, let's say this was here, this was the entry, this was the trend established, this is false breakout, and we have, look at this, we have it here. So we should never allow, after these blue EMAs went up, we should never allow blue EMAs to go down. This is not the step toward trend establish. Okay, so we need to see a good retracement. This was not a good retracement because blue EMAs went below red. This is good retracement when blue EMAs stay above. So this is now the trend. Okay, this is the bounce here, and look at this. We need to enter a long trade. So Fibonacci from left to right. Okay, and look at this. This was the entry. So this is 50 Fibonacci and touch of red EMA. So this was the entry here. The price went in a drawdown and that went in a profit. Okay? And very often you will see that you should, I think most of the time, you should be able to draw only one Fibonacci. You don't have to wait for multiple of Fibonacci. It's pretty much, it's hard sometimes to wait for that. So very often you will see when you have a strong trend, you will see this happening. Okay? So this was probable trend, but at this point we can see we don't have any bounce because blue EMAs went below red. Now we again have a potential trend. Look at this candle, but look where EMAs stayed. They stayed above. So at this time we counting this as retracement. Low, high. After this candle we are waiting for the price to pull back. It's very easy, guys. You just need to practice, okay? So look at this. Bounce, low, high, you draw Fibonacci and you wait for the touch. This is the first touch and this is even deeper touch. And the price went up. Okay? Now, stop loss can be used in both ways, which I will tell you, but you need definitely to demo test it to see how it's better. Standard stop loss, 10 pips plus spread above last swing high or low. It's called standard stop loss. So we use 10 pips plus spread above last swing high or low. Simple. Okay? Or you can use 25 pips fixed stop loss. So in this example here, our stop loss would be 10 pips and spread, which is 1 pip. So 11 pips below the swing low. From this point, okay, this is the entry, and the stop loss was 11 pips or 25 pips fixed. Target price can be used also in two ways. Standard use of Fibonacci extension, so you know how to draw Fibonacci extension. We don't need to mention that again. So standard use of Fibonacci extension, okay, or fixed target price, which is 50 pips, okay. So standard use of Fibonacci extension or fixed target price, which is 50 pips. Okay, this is one of the examples. Then we can go also, we can move the examples. Now guys, just confirm if everything is clear up to this point, so I can show you the example of trades. Just say yes if everything has been clear so far, okay? Or if something is not clear, I can help you. I can answer some questions if something is not clear. Okay, everything is clear. Great. I have confirmation that everything is clear. Great. So, this is also the example. We have some sort of uptrend here, but we can see that at this point here, we might have a probable trend change. And this is, look at this, all 5 blue EMA below red. This is the point when all 5 blue EMA went below red EMA and we have a trend. So this is the trend, confirmation of the trend, and this is the pullback to red EMAs. So guys, don't forget this rule. You need to wait for a pullback, okay? Wait for a pullback to EMAs. After you see the trend, you need to wait for a pullback. So this is the trend, and this is pullback. Look at this. After this candle here, the price started to retrace. So after this candle, price started to retrace. You wait for the end of retrace. This is the point. After this candle, we can assume that this was the low. Okay, after this bullish candle, we assume that this was the low. So we draw Fibonacci from left to right, from top to bottom, and we wait for the touch. Okay, so this is the first touch here. This is the first touch where we trade, or this can be also tradable. So this level is tradable, this level is tradable. So Fibonacci touch inside long-term traders, red traders. So this is the first possible entry, this is the second possible entry. Stop is exactly 45 pips, okay? Because we count a last swing and 10 pips and the spread. So it is 35 pips. 24 pips because the difference between high and low is 24. Spread is 1 pip, let's say 1 pip for example, and 10 pip stop loss above. So 35 pip is a stop loss. So price almost hit the stop loss here, but it wasn't hit. And then look how the big drop is. I have noticed many times when price is going in a trend and then it almost hits the stop loss, when it resumes the trend, it's usually much stronger than it was the initiate move of the trend. So look at this. This was a nice drop. And this was big retracement. It almost hit stop loss. But look at the drop afterwards. It's huge. So that is what can happen sometimes. Bigger retracement just to give us a better basically entry and bigger target. So this is the example of a short trade, okay? Now let's move on to another example where we can use 2 moving average, okay? We have definitely here, we don't have anything. We see that blue EMAs are inside red EMAs, and they are mixed together, so we don't know where they will go. So they decided to go below. So this is a short trend. Let's see if we will have retracement. So this is the start of the trend when this blue EMA finally crossed. Now you wait for the retracement. This is the retracement here. So after this candle, and this candle starts to form, we mark this as a high and we wait for the low. This candle was basically had a low here, and this candle, when it started to form, we can mark these 2 points, swing high, swing low, and this is our retracement. First entry is here, look at the confluence point, and second entry could be here, although it's a little bit high, but that can be second entry, because blue EMAs are still below red. If these blue EMAs went above red, we wouldn't count that as potential retracement. So these are 2 points. Look how confluence is clearly depicted. 2 points, 50 and 38, and here 78 and 50. Okay, and look how the price behaved after that drop. Okay. Next example also, we have a possible trend, and this was pullback. Now we could obviously use some form of Fibonacci here, but look, this is basically only the first retracement, so we don't have any clear picture whether this will go up and down. So we need to see that the trend is established and the price is really pulling back. So this is the case. The trend is pretty much established here. Look at this gap. And what happened is basically, look at the pullback. So this is the pullback candle, and we mark swing high and swing, sorry, so this is how we will go step by step, because it may be confusing. So this is the first step. We have a trend, and it goes up, 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 up to here. This candle didn't break this high. This candle didn't break this high. This candle didn't break this high. So this candle definitely was a start of retracement. We have retracement undergoing. We wait, we wait, we wait until the swing low. This cannot be swing low because this should be at the red moving average, not at this blue moving average. So this was the low, and then the price started to retrace. So after this candle here, we don't have any new low. So this candle, when it's closed, we draw Fibonacci from top to bottom. Sorry, this is actually uptrend, so we from bottom to top, so from this point to this point, and we wait. So we wait here, and look at this. The price was touched, even though if it wasn't touched, this is only 3, 4, 5 pip difference, so it can be traded 3, 5 pips. It's not much, but look what happened. The trend continued in desired direction. Okay. So it's pretty much straightforward. I will use also once more this opportunity to show you how you can trade. And if you didn't memorize the slide, guys, please do this now. I will give you some moment to memorize this, and you can ask me some questions if you're not sure how to trade this. I think it's pretty much straightforward and pretty much simple, and it's definitely good in trending environment, but in trending environment, so when we have a nice trend, this system should be working like a candy. Okay, so red are long-term traders, and we have 30, 35, 40, 50, and 60. Blue EMAs are 3, 5, 7, 10, 15, and those blue EMAs are showing us short-term traders. Okay, so steps for taking the trades. Wait for fast-moving EMAs to cross slow-moving EMAs. That will mean the trend, that the trend has been established. Then wait for a pullback to EMAs. Okay, now wait for the price to retrace to the red, guys, this is important, to the red EMAs. So wait for the price to retrace to red EMAs and hit multiple Fibonacci levels, and then you enter a bounce trade. So step 1, this is the first step. This is a long trend, and this could have been a start of a short trend. Then we have again uptrend, but look at these EMAs, look where the swing was, and we don't know whether that is a downtrend. That is whipsaw, we call it whipsaw. Then it's still above, but look at this low, again whipsaw. Only at this point here, this is the low, so you need to know how to define swings. You know that already. Okay, you know that already. This is the swing high, this is the swing low. And this could have been an entry, but it was very close to EMA. Now it's a bit discretionary. It's only 2 or 3 pips close to EMA. So you can decide whether to take entry or not. But your next step should be drawing your Fibonacci from point A to point B, because this was actually the retracement. Point A, point B. Can we use other Fibonacci? Yes. Point A, point B. Find the confluence points in the red zone. So in the red zone. So the first confluence point, which is very close to red zone, is this one. 38.2 and 38.2. And the price hit that and went down. Okay? When you don't have 2 Fibonacci retracements and you are only able to use 1 Fibonacci retracement, you should draw a Fibonacci, wait for 50% touch along with slower EMA touch, that is red, and enter a trade. Okay, step by step. Let's see step by step. First of all, we have spotted the trend. Okay, the trend has been spotted at this point. Okay, but we don't have any particularly good retracement. We can make a retracement from this point to this point, and we still can have an entry here. But I use this opportunity to show how strong trend looks. And this is strong trend. Look, it will happen on other pairs, not just single pair. I took euro dollar, but you can see this on multiple pairs. Okay, so this is actually a big start of the trend when price starts to move up. We have retracement, but this retracement wasn't to this red long-term traders. Okay? So we actually, here at this point, we had a trade, and at this point here, we also could make a trade. I didn't put Fibonacci, but this is obvious. This point too could also be a trade. And both trades, if executed correctly, would give us pips. This was the first and only usually the first entry is most profitable. So we have the trend, pullback. This is shallow pullback. And we have a low and high. Yeah, I told you we can use this low and high, but this is more obvious to me. This was low, this was high. Look how those candles look like. Low, and look at this, high. Those two candles. It's pretty much simple. And this candle basically was the entry. Then this could have been probably, I think this is Fibonacci number here, Fibonacci number here, and again, profitable entries. This is not tradable. Stop loss, 10 pips plus, 10 pips above last swing high and low plus spread, or 25 pips fixed. That is what you should also need to work on to see how they complement each other, which kind of stop loss to use. And target is Fibonacci extension or fixed target 50 pips. Obviously, if you use 25 pips fixed stop loss, you should aim for 1 to 2 risk to reward with 50 pips target. Okay? And this is the other example. We don't have any trend here. We wait for the trend to be established. We have the trend established here. We wait for pullback. This is the pullback. And this was obviously swing high. Now you should wait for swing low because you are going short. Okay? Bang, bang, bang. After this candle, this is the low. This candle, while this candle was a living one, you put your Fibonacci from top to bottom, and you actually trade this level, or you can trade this level, because those two levels are held in red EMAs. And you can see the price went in a drawdown, but then it dropped huge for a huge profit. Okay? And we can also see this example here. We have a trend established at this point. We wait for pullback now. Pullback, pullback, pullback happened here. This is the high. Now we wait for the low. Okay, this was the low, and now we wait for the pullback. We make Fibonacci from high to low, and we wait for the pullback inside red EMAs and inside Fibonacci confluence. Also, we use this high and this low here, because we could use this, but this was obviously swing high, this was swing low. So this is swing high, this is swing low. Double. But sometimes, very often, I tested this system. I didn't use double Fibonacci, but definitely here at this point you can also use one Fibonacci, because yeah, it's very clear that this is Fibonacci point, but it's also 50% Fibonacci inside these red EMAs. And this is also, yeah, this is a confluence. It's good to have double confluence, but this is also 78.6 of this minor swing. So you can try to take this. This is the top of these 5 EMAs. And look at this. Okay? Same goes from here. This is the trend. This is the move. So we have swing low. We have swing high. We make one Fibonacci retracement from bottom to top. Inside this red EMA, we have only 50. So we wait for the price to come very close to 50 or touch it, and this is the entry. Okay? So guys, this is everything about this introduction of Guppy moving average. It's pretty clear. You see, it's pretty straightforward. It's not hard. It's pretty clear. I encourage you to try to trade this system. The question, what we must do before strong news? Definitely, before strong news, put your stops, always trade with stop loss, and do not trade during the news. No, do not trade during the news, guys, because news can hit your stop loss and then go in your direction. So you shouldn't trade during the news or before news. Try to see when there is no news, try to trade it and put your stop loss. Okay? Try this. This is the first webinar about Guppy moving average, and this is the most important introduction webinar, because next time when we talk about Guppy, we'll be using another Guppy method which is more complex with this one. But I encourage you to try this, because especially if you're a new trader, because it can help you to basically learn few things about Fibonacci, to make profit, and to definitely give you trend direction. And my recommendation is to use 15 minutes 15 minutes time frame. Next complex seminar and webinar will be in March. I didn't prepare this for February, but it will be held in March. Until March, guys, please practice this. Okay, please practice this. The question, thank you, Tarantula, for the informative webinar. Hope tomorrow's webinar with you and Chris will be recorded. May not attend it. Yeah, hello, I hope it will be recorded, but I'm not sure whether the webinar will be uploaded to the site. But I hope it will. I will be recording it, definitely, but I'm not sure if it will be uploaded. But definitely, what I wanted to say about this one, guys, if you are interested in Guppy moving average, check this one. This is good. It's simple and it's first one, but it's good. And until March, when I present you more complex Guppy moving average system, try to practice this one, okay? Because this is different than simple 1 EMA or 2 EMA, okay? look, we have 5 EMAs, we have 5 EMAs, and all of them need to be above or below. And then we wait for retracement into the red, okay? And then we find entry in the red with Fibonacci. So this is the combination of price action and indicator, EMA. So guys, thank you for listening to me. Thank you for the comment. Thank you, Daniel. Thank you, Lo. Thank you, everyone. I will be with you also tomorrow with you and Chris. Expect new analysis tomorrow. We had a great week behind us. Many, many good trades. You saw many good trades after last session recap. Do not forget to sign up for next session recap. 3 pips, always good, right? Thank you. I will be here with you soon. Cheers and trade safe.